You're listening to The Wrap,
a Warren Averett podcast for business leaders,
designed to help you access vital business information and trends when you need it,
so you can listen, learn, and then get on with your day.
Now, let's get down to business.
Hello, everybody, and welcome to another episode of the Wrap podcast. Look forward to having this discussion with you today. This is episode 66. We are talking to some of our experts, both internal and external, as it relates to the real estate industry. And happy to have them with us today. But also with me is one of my co-hosts, Derek Johnson. Derek, a pleasure to have you back, sir. Thanks for being with us.
Paul, it's the pleasure's all mine. I appreciate you having me back again. It's immediate gratification when I get the invite to come back, because it means I didn't mess it up too bad the last time.
You did a great job, Derek. We're glad to have you.
Thanks.
So who do we have with us today? We're talking about real estate.
Yep. As excited as I am to be here, it's because we have our own personal firm expert, fan favorite, Cristy Andrews with us. And then we also have very special guest in David Borsos. He is with the National Multifamily Housing Council. I'll let them share a little bit more with you about their proficiencies and expertise.
Well, thank you, Derek and Paul, for having us. I'm Cristy Andrews. I lead Warren Averett's real estate industry group, and I have been hearing lots of concerns from clients, and have had multiple conversations with Dave Borsos, and so we thought we would have him come on and talk to you a little bit more about the capital markets.
Hey, listen, I appreciate the opportunity to spend some time with all of you. As Cristy has mentioned, she and I have spoken quite a bit over the last couple of months about what's going on in the multifamily industry. So I look forward to sharing a little bit of what's going on at NMHC, or National Multifamily Housing Council, where we are a federal-facing advocacy firm for the apartment industry. So we represent typically more of the larger owner, operator, developer, managers, as well as people who finance the properties throughout the country. And any of the issues, both from a legislative perspective or a regulatory perspective, that may be impacting the industry. My own specific responsibilities at NMHC are, as I cover anything related to capital markets. So whether it's debt access or whether it's equity, and putting those together to finance a property, and if there's any regulatory or legislative issues that are impacting those issues, then I get involved. And then one other vertical that I also am responsible for, and those of you who have kids either going to college or in college, is purpose-built student housing. So I get to spend some time advocating for that sector as well, with somebody who currently has a kid at Clemson University. Understand what the ins and outs of that with personal experience. So look forward to the conversation with all of you.
And we're happy to have both of you with us today. And for our listeners, you're going to get a little bit of both the outside the industry and the accounting industry and the accounting aspect of the real estate industry. So this is going to be a good discussion. Dave, let's start it off with what Cristy kind of mentioned. Kind of give us that overall status, if you will, of the capital markets and everything that's related to that as of today. And we do need to say that we are recording this as of November 7th. So should anything be different once this gets released, just want everybody to have a time frame of when we're talking about this.
And Paul, the specific date is actually very interesting given the challenges in the capital markets right now, and liquidity is certainly a challenge, right? Every one of us have seen the continued rising in interest rates, which has had a dramatic impact on overall liquidity, and has also actually kind of ground to a halt some of the other typical activities you see in the capital markets, be it transactional, right? You look at a lot of the large brokerage firms are reporting not just a little double-digit decrease, but dramatic double decrease in their total sales volume for this year. And so a lot of that is really dependent on where interest rates have gone. I went back and looked at the 10-year, and the reason I look at the 10-year is because oftentimes the frequency of pricing debt for multifamily is off of the 10-year treasury. There's a lot of others, but that's probably the most common one. And rolling back to sometime in August, we were at about 3.98%. So we were under 4%. And then over the last 60 days, it went as high as 5%. It's now back down to in the 460s, and it'll be something different tomorrow as you talk about wanting to pick a particular date. So that volatility is really a big hindrance for people looking to access debt, and it's causing a lot of confusion in the marketplace. It's causing a lot of people to step to the side and say, I'm just going to wait this out. When's the Fed going to be done? What's the impact on long-term interest rates, and how can I actually finance a property if I need to do that? And it's really causing a lot of concern. One of the other things is, we need more housing. You look at increase in housing costs, it's not just because of inflation, it's from overall demand. And one of the problems is when people stop building, which is what's happening right now because of interest rate levels, volatility in the markets, et cetera, takes about 2 years, right? If you had something ready to go, it takes about 2 years. Well, 2 years from now, if construction is way down because of all the things we just talked about, that housing problem is just going to get exacerbated. So we may have a lot of deliveries coming in 24, but just, we can have this conversation 2 years from now, and I think we're going to be seeing a significant decrease in the number of apartments being developed, which is certainly going to be a negative impact to the housing cost market.
Tell me a little bit, maybe Cristy, you can help us out here, but how are these challenges and these opportunities, how is it uniquely going to be impacting things for our clients and for whom in the industry?
Well, I know a lot of my clients are just really concerned with some of the banking issues and liquidity, the fact that they are having a hard time with getting financing. And then once they can, just the interest rates being so high, they don't want to get locked in on a high interest rate and just not being able to really fund the deals and make them work from a financial standpoint. So I think there's just a lot of uncertainty and just concern, just approaching this 2024 and what's going to happen, from a tax standpoint with just some of the expiring aspects of the Tax Cuts and Jobs Act, along with the interest rates and, liquidity, just all of it is causing a lot of concern and nervousness, honestly.
Yeah, so along the lines of bank liquidity, I think it's a great question, Derek. And, roll back to the beginning of this year where you had a couple of bank failures and some of those were caused by nothing other than the rise in the interest rate and what the banks had on their balance sheet and how they manage that risk profile. The second part of that is, we all may be sitting in an office right now, but a lot of people are not. And if you look at the vacancy rates in office buildings where banks have been a big provider of finance for that sector, there's a lot of disruption going on, a lot of offices that are really struggling to try and maintain any level of occupancy in their buildings. And a lot of people are kind of taking a hybrid approach back to work where they may be downsizing in the amount of seats that they want to take on an expiring lease. So there's going to be a lot of disruption in that office sector, which is going to have a negative impact on banks as they kind of pull back overall and say, how much capital do I need? What are the losses that I may experience? And so, they're looking at that aspect of it. And then secondly, as again, I talk about it, focus on the regulatory side, and I spend a lot of time with bank regulators as well. And there's been a couple of things that they've been working on as well that are going to put pressure on the total amount of capital that banks have to hold, partially as a result of some of these bank failures that we saw in the beginning of the year. And oh, by the way, interest rates are really high. So, with where those banks got into trouble earlier this year, besides their commercial real estate portfolios, they weren't paying us anything to put our money in a bank, right? And all of a sudden, interest rates started going up, and people said, I can make a return on going to buy Treasury. So all of a sudden, banks have gotten more expensive in terms of how they fund their loans. And so this has also caused a pullback for them as well. So there's a whole bunch of things that are unfortunately, coming to a head at the same time from the banking sector that are really constraining the availability. And I have some nationally based, very, very large owners who go to access debt when they're going to go construct or finance something. And historically, because they're great owners and they have a great portfolio and they have had historically performed very well, they used to say that, I got 20 banks lined up or 25 banks lined up. And now even those guys are saying, there's maybe only 4 or 5 banks. And while it's great they've got a couple, it still is a very constrained market. And overall, that liquidity is a challenge. The one group that's providing liquidity happens to be Freddie Mac and Fannie Mae. And that's, I also cover their regulator in Freddie Mac and Fannie Mae. However, just talking about the overall size of the market, each year their regulator puts in place a cap. How many loans can they buy? And each one of them have $75 billion worth of total capacity that they can purchase loans in the open marketplace. Given the decrease in the amount of refis that are going on, decrease in the amount of transactions that are going on, I'll give you Fannie Mae's end of third quarter was only at $42 billion out of $75 billion. Fourth quarter is not going to be all that big. So what you're going to see is even Fannie Mae and Freddie Mac, or providers of liquidity, are going to see dramatic decreases and not even getting close to meeting their cap. So just to give you a sense that it's just overall the market is super nervous and very much constrained in terms of what their outlooks are right now.
So I guess, Dave, though, with the real estate industry, they're not taking, the opportunity from Freddie Mae and Freddie Mac just from the standpoint of the interest rates. They don't want to lock themselves in, so they're just waiting. And so they're not at capacity just from the standpoint that nobody's willing to take the risk right now.
Yeah, so there's a couple different things that are going on in terms of, if I'm an owner and I have a long-term loan and it's not maturing anytime soon, I don't really have a lot of incentive to do anything with that. I don't want to refi it. I probably don't want to sell it because interest rates are super high and it's going to depress the price in which I could probably sell that at. So you have a lot of people who are just operating their properties. On the other hand, there are some people who have loans maturing. There's some floating rate loans that either have their caps expiring or their floating rate loan is expiring. So what are they doing if they're forced to go to the debt markets? And what's happening, and if you look at a lot of people are doing short-term loans. Fannie Mae and Freddie Mac have been doing a lot of 5-year loans, even though I talked about earlier that we were going to do 10-year, oftentimes doing 10-year loans. A lot of people are doing 5-year loans. And the reason they're doing those is because it's almost like getting a floating rate loan without having to buy a cap, which is exceedingly expensive right now. So when you take floating rate, and look at where the 10-year treasury is or where SOFR is, and then you add a spread, and then you have to add a cap. If you're going to borrow on a floating rate basis with a cap in it, you're probably paying somewhere at 9%, maybe even up as much as 10%. Whereas if you do that with a 5-year and you can refinance earlier out of that, you're going to save some money. So you're seeing some people take advantage of the ability to do shorter term loans because they are worried about what you said is, I don't want to lock up 10-year money at 8%. I just don't want to do that. What can I do to make it less costly to reposition myself when I think interest rates may come down in the future?
That's a really good question, Cristy, and a great answer there, Dave. Thank you very much for that. And when you start talking, Dave, about liquidity issues, and Cristy, I want to go to you because I think of when he says liquidity issues, business owners, clients are sitting there going, well, there's going to be some more expense on my books this year, right? That always fits, right? So if we're looking at the finances, if we're looking at the financial statements of a real estate industry client, what are some of those other expenses that they're probably going to have this year that maybe they didn't have last year, they're higher this year? Can you kind of speak to that a little bit?
Yeah, so right now, our clients are dealing with increased property tax assessments. With the increase in values, those assessments are just through the roof. Also, insurance costs, those have gone up exponentially. And I don't think I've talked to a client in the last several months who, number one, haven't complained about insurance and really just trying to figure out a way that they can minimize that cost, looking at reevaluating their coverage, and just really trying to price that out, just doing anything they can do to control those fixed costs that really have just gone through the roof. And Dave, I know that you all have seen that as well. And, a couple months ago at the annual meeting, I know a lot of your customers, they were complaining about that. And that was one of the hot topics at the conference was insurance cost and property tax assessments.
Yeah, so insurance, clearly the heat is not turned down, not at all. It continues to be a major problem. In fact, there was a hearing here in Congress last week that we submitted a comment letter raising those concerns that you mentioned. And clearly, if you're in areas such as Florida, Louisiana, California that have experienced climate-related issues, your property insurance has gone through the roof, right? So that has clearly been a big concern, and sometimes you can't even get access to it. So we did a study earlier this year. We produced that, and we also made recommendations in terms, I think historically, you just kind of call your broker up and say, hey, I'd like to get renew my insurance. And now there's probably some things that, if people are owners out there that are seeing these big increases, take a look at your properties. Take a look at, does the insurer understand what you may have done to your own property to make it more resilient, that you may have upgraded some things. And so, maybe a way to drive down some of those increases that people are seeing. But it still is a concern where if you look at last year, Florida experienced some pretty bad weather events, and there were a number of insurers that either withdrew from the state or they went bankrupt. So continues to be a major issue, continues to be a focus for us. And we even are hearing from some of the regulatory agencies that they're trying to figure out what they should be thinking about doing as well.
Want to receive a monthly newsletter with wrap topics?
Then head on over to warrenaverett.com/the wrap and subscribe to our email list to have it delivered right to your inbox.
Now, back to the show.
So if we're talking about finances, let's go to probably one of the favorite topics people want to talk about beyond that, and that's taxes. It's exciting. It's fun. But we've got all of these things coming up, right? We have the Tax Act expiring in 25. We've got the deal with the bonus depreciation happen. I by no means am a pundit, but you guys are. So share with us your thoughts around some of these taxes that you're seeing out there now. What's going to be happening?
Well, one of the great things about the Tax Cuts and Jobs Act is it really allowed for 100% bonus depreciation on a lot of lesser life assets, which really, in the real estate industry, there was a lot of assets that could take advantage of this. For instance, land improvements, personal property, for multifamily appliances, those type things. And real estate owners and developers really have been able to benefit from that. Well, starting in 2024, that is going to start, reducing 20% per year until, it expires. And, Dave, back in September at the annual meeting, there were many members of the Ways and Means Committee from Congress there and spoke about some upcoming, extensions of this, one of which was the bonus depreciation, which really, it made everybody excited. Everybody loves, an extension of a tax break. But as time goes on and fighting continues in Congress, it seems like I'm not so sure that we can predict whether that will get extended in 2023 as we hoped. I don't know if y'all have heard any different.
So we haven't. Look, I think it would be hard to ignore the fact that the House took a while to get a new speaker. The current extension for the budget expires in 10 days. So there's a lot on their plate to get through the appropriations process to say we're going to fund the government. It's got to be the major focus, right? So then if they can get that done, they'll do another continuing resolution to kick it down the road. Then you start to run into Thanksgiving. You've got other things where Congress gets diverted in terms of where they're going. The question is, can they actually pass anything from a tax perspective before the end of the year? It's probably going to be more of a challenge this year than other years because of some of this disruption that's going on. And the question would be are people willing to sign on to something that's an extension? I'd love to give better news, but quite honestly, this one's a little bit up in the air whether it's going to get done or not. And then, as you mentioned, the next thing, and even though 2025 seems like a long way off, I sometimes think of Congress as a bad student who doesn't study for the final until the 2 days before the final, and then they kind of really kick in. And that's a little bit like that. So we're going to have these, this major tax act expiring at the end of 25, and they're probably going to wait a long time. But the other thing that interferes with that is we have a presidential election next year. Senate has a good chance of flipping the Republican direction, and the House has a good chance of flipping in the Democratic. And then what happens, right? And so, and who knows who's going to be in the White House. So there's a lot of unknowns that cloud the kind of forward direction of what's going to happen. But it's something that, look, it's going to be meaningful. There were a lot of things that happen in that Jobs and Tax Act that were beneficial, that we fought to get included in there or to get excluded, that were beneficial to the real estate industry. So it's something we're monitoring very closely, and something that, if I were to kind of tell you to have your clients watching, you need to be prepared. If things don't go our way, what are we going to do to anticipate the impacts?
Yeah, that's a good point. Back in September, they were really, I think from both sides of the aisle, they were promising to work together and compromise. And we're very hopeful. So I think we can continue to hold on for hope. But I think as you point out, that our clients and real estate developers out there need to be prepared for the anticipation that they may lose a portion of that deduction this year.
Interesting information, and definitely helpful for the folks listening in. One of the things all industries mention is technology and its impact on that industry, and it's kind of different for everybody, right? Manufacturing, governmental, some are lagging behind in adoption. Some are trying to be trailblazers. Where does the real estate industry fall as it relates to using technology to drive solutions to some of these problems we've talked about? Is there something to speak on there?
Well, I would actually hope that some of your clients took the opportunity to visit with us at our OpTech conference last week in Las Vegas. We had over 3,000 people there, so by far our largest attendance ever. And exactly, Paul, what you just mentioned, there's a lot of technology-driven solutions that are out there. Some of them resident-focused, some of them are owner-focused, management-focused, and so there's a lot of activity going on. One of the things that I would, kind of walk away from, centralization is a big deal. For those who own multiple properties and bigger property owners, they're looking at how do I centralize all of my operations and not have overlaps. Clearly, the ability to address labor shortages. Anything from, do you have on-site managers, or is everything a virtual tour, to how do I find maintenance people for my properties? And there are people who are providing solutions for those types of things. And then, the screening process for inbound residents is also something where, on one side, there's a lot of issues that are getting created with fraud. We have a lot of people, and I'm sure some of your clients are experiencing fraudulent applications. People can buy, paychecks and W-2s, et cetera, off the internet. They all look very good, but they don't have ever an intent of paying for any of their time in a unit that they then may be difficult to evict from. I have two things where people commented there that 65% of their applications were fraudulent. And so there are people looking to provide those kind of solutions as well. So on the resident-centric side, there are people who are providing positive rent payment reporting. They are looking at splitting payments across a month if their clients are looking at that. So there's a lot that is going on that is technology-driven solutions for a lot of things that we do, from kind of A to Z, as it relates to everything that has to do with operating and managing a property.
There's a lot of good information there. Definitely things to consider. As we look forward, what challenges or maybe what opportunities are there on the overall business strategy?
So there's a couple of things. I mentioned before about people having floating rate loans that mature. I do think that there are potential opportunities, to the degree that some of the clients are good operators and they have access to capital. You may have some people who bought at the peak of the market in 2021 when the floating rate interest rates were basically zero, and they bought them at a floating rate, and they said, hey, this is great. And all of a sudden they realize, I don't really know how to manage a property, and my interest costs are gone through the roof, and they may be selling their properties in a stressed situation. Now, having said, there's a lot of other people chasing this kind as well, but it may create an opportunity, if you know somebody off market or whatever else. So I would encourage people to take a look at that and make sure that they are looking at those types of things. On the same note, from a pure strategy perspective, one of the mantras that came out in September, as Cristy was talking about, is there are people talking about surviving until 25. And the idea there is they think interest rates are going to be high in 24. You're still going to see some stress and disruption in the market, but things will get better in 25. I can't tell you whether they're going to get better or not. They may. Look, we're all going to be optimistic about it, but what they're simply saying is, I think people are still going to hunker down a little bit in 24. We'll see what happens. The one other aspect of it, which may help a little bit, even though rates may be higher. Last summer, when the Fed did their first pause, a lot of my finance members saw a pretty significant increase in interest of people buying and selling properties. And part of the reason was because the 10-year was really flat, didn't have a lot of volatility. So we could take the volatility out of the 10-year. If the Fed finally says, we're done, then maybe that long end of the curve stays a little bit more consistent, and you may see some of the market movement with new pricing, they're going to recognize the fact that we're not going back to a 2% 10-year loan. It's going to be higher, and we're just going to figure out how to make it work with that. So those are kind of things that if I were in the market and operating, I'd kind of keep my eye out.
Cristy, anything you want to add to that?
No, I just would piggyback what Dave said. I think for many that do have access to equity, there'll be some good opportunities. And I think for others, I think they will hunker down. I think they will focus a little bit more on the costs they can control, on budgeting, those type of things. And we'll hang in there until interest rates come back down and, the market shifts, as it always does. It's cyclical.
Here on the wrap, we like to wrap it up in 60 seconds or less. What is the one thing you want the listeners to know or to leave with? It may be something you've already said. It may be something we haven't talked about yet. But what is that wrap up? And Cristy, we'll start with you.
I would just say that, the wrap up would be to watch the market, to stay in close contact with your advisors, and hold on until 2025.
So I'm going to put that plug in to survive until 2025. But the one other thing, and again, I don't know from your listeners who is a member of NMHC to the degree that you are. We put out tremendous amount of research, information on advocacy. I'd mentioned earlier about insurance. We just put out paper out on artificial intelligence, which certainly has the interests of Congress. They're all scared about what does AI mean. And so highly encouraged to kind of stay informed. And, we put out a lot of great information to really kind of keep people in touch with what's going on in the marketplace. In addition, as soon as I hang up from this, from a regulatory perspective, the federal home loan banks are getting some, new guidance from the regulator that may be beneficial for finance from the banks that are members of the federal home loan banking system. So there's a lot going on here in D.C. that, from a regulatory perspective, that people should kind of keep their ears and eyes open on.
That's wonderful. Hey, listen, heartfelt thank you to both of you, David and Cristy, for joining us. I certainly learned a lot. I know our listeners have a lot to take away and unpack. Very much appreciate your time. We know you're both very busy with this. Thanks so much.
Appreciate it. Thank you.
Thank you.
Thank you all very much.
And that's a wrap. If you're enjoying the podcast, please leave a review on your streaming platform.
To check out more episodes, subscribe to the podcast series, or make a suggestion of other topics you want to hear.
Visit us at warrenaverett.com/the wrap.